In simple terms, price moves up when buyers are willing to pay higher prices and moves down when sellers are willing to accept lower prices. This is how all price movement happens in the market. Now, what are the supply and demand zones on the chart? A demand zone is an area where buyers previously entered the market and pushed price higher. Similarly, a supply zone is an area where sellers have entered the market and pushed price lower. These zones are important because markets often remember where strong buying or selling occurred. When price returns to a supply zone, sellers may step in again, potentially causing price to move lower. When price revisits a demand zone, buyers may become active again, which can push the price higher. In simple terms, demand zones act like potential support, and supply zones act like potential resistance. They help us identify areas on the chart where price is more likely to react rather than move randomly. But the key point here is that we want to look for aggressive buying and selling when identifying supply and demand, not slow, sideways movement. Strong zones are usually created by impulsive price moves, showing clear imbalance between buyers and sellers. To make things more objective, we need to see 3 green momentum candles to mark an area as a demand zone. Similarly, 3 consecutive red candles with large bodies and strong push distance would make a good supply zone. The reason is that we want to identify an area where traders previously showed interest, rather than just small moves in the market. Now, how do we correctly mark the supply and demand zone range on the chart? While traders use different methods to mark these zones, the most important rule is to focus on the area where the move began. Marking the start of the move largely depends on the candle's formation.